In this video, we will be discussing the computation and allocation of differences schedule. The computation and allocation of differences schedule, or CAD, is about to become your new best friend. For pretty much every problem we will do for the rest of the class, you will need to prepare one of these schedules in order to complete the problem. The purpose of this schedule is to document the fair values of the subsidiary's assets and liabilities as of the date of acquisition. For a stock acquisition, we will not be recording these fair values in the parent general ledger as we did for asset acquisitions, and the subsidiary probably won't appreciate us messing around with their general ledger either. Therefore, the adjustments required to report the subsidiary's assets and liabilities at fair value and to establish goodwill will occur only on the worksheet. Since entries made on our worksheet are temporary rather than permanent, we will need to refer back to our CAD every reporting period. The CAD itself is prepared on the date of acquisition and does not change, but we may need to refer back to it in future periods. This is another one of those slides that is more for your reference. So instead of me reading through it, let's look at our example and I will show you how the CAD works. For this example, we're going to revisit Peach and Sorts from our last video. So recall that on January 1st of 2013, Peach Company issued 1,500 of its $20 par value common shares with a fair value of $60 per share in exchange for all of the 2,000 outstanding common shares of Schwartz Company in a purchase transaction. They also gave us the balance sheet of each company just before the acquisition went through. And in the last example, we prepared the journal entry to record the acquisition. For this part of the example, we need to prepare the computation and allocation of differences schedule for the difference between book value and the value implied by the purchase price. So the first thing we're going to do is across the top here, we're going to look at our columns. So we're going to have our parent column, our non-controlling interest column, and a total column. So the first thing we want to do is figure out what is the ownership by the parent. In this case, we bought all of the outstanding shares of Schwartz, so that means the parent has 100% ownership, and that leaves nothing for our non-controlling interest. So we only have one owner, and that's the parent. Our purchase price is going to be what we paid for our 100% share. So if you recall from last time, we recorded our initial investment in S at $90,000 because that was what we paid. We issued stock that had a value of $90,000. So that's our initial cost. Then normally what we would do is we would go over to this total column and we would extrapolate our purchase price on the shares that we bought to try to estimate the value of 100% of the shares, because normally we won't have bought all of the shares. So we're going to do this math even though it's a little bit silly at the moment, but what we'll do is we'll take our purchase price and divide by our ownership percentage. And what this does is it assumes we could buy the remaining shares that we didn't buy at the same price as the ones that we did buy, and that'll give us a value for 100% of the company. So again, in this case, that's silly because we did buy all the shares, so we know that the entire company is worth $90,000. Then what we're going to do is we're going to compare, so this represents the fair value of the entity as a whole. We're going to compare that to the book value of the entity as a whole. So what we're really interested in is the value of net assets, which would be assets minus liabilities. But that's the same thing as equity because of how our accounting equation works. So what we're going to do is we are instead going to add up all of the equity accounts of our subsidiary. So if we look at the balance sheet of Schwartz, we see that they have 3 equity accounts: common stock, other contributed capital, and retained earnings. I've already put those into our computation and allocation of differences schedule for us. So there's 3 equity accounts. So there's 3 equity accounts in our CAD. Now, had the company had 5 equity accounts, we would have 5 lines here. If the subsidiary had 2 equity accounts, we'd have 2 lines here. Every single equity account should appear in the computation and allocation of differences schedule. Okay, so when we buy the company, we are then going to compare what it would have cost us for 100% of the company versus the book value of 100% of the company. So we're going to go look at the company's balance sheet, and we see that common stock was $40,000 as of the date of acquisition. Other contributed capital was $24,000 as of the date of acquisition. and retained earnings was $19,000 as of the date of acquisition. So if we add up all of those accounts, we get a total book value of $83,000. Now we're going to compare that between the fair value of the entity as a whole, or the implied value, minus that book value, and that gives us a difference between implied and book of $7,000. Now, once we get to this point, there's two reasons that we might be willing to pay more than the book value for this company. It could be because we believe that the assets and liabilities of the company are worth more than their book value. So that's that fair value that we'd be willing to pay for in terms of net assets. Or we might believe that there is goodwill, or both. So we need them to tell us. And they told us that any difference between book value of equity and the value implied by the purchase price relates to goodwill. Now that we have our computation and allocation of differences schedule, we can use this to put together our eliminating entries that we need in order to put together a consolidated balance sheet. So we need to remember that our starting point is we're going to take our parent general ledger and add to it our subsidiary general ledger, like we did when we did this example the wrong way previously. So we took our parent general ledger and added to it our subsidiary general ledger, which gave us this combined column. We need to figure out what adjustments need to be made to this combined column in order to get us to a consolidated balance sheet that makes sense. So one of the things we mentioned before is that we wanted to get rid of our investment in S. So investment in S was an asset account. In order to get rid of it, we're going to need to credit it. We also know that we recorded our investment in S at our initial cost, which was $90,000. That can be found in our computation and allocation of differences schedule. We also mentioned last lecture, that we were going to eliminate our investment in S account against the subsidiary equity. We thought we also needed to get rid of that. So we need to eliminate any equity accounts that were on our subsidiary's balance sheet. Well, those are also in our computation and allocation of differences schedule. So equity accounts have a normal credit balance, so to get rid of them, we are going to debit them. So common stock, other contributed capital, and retained earnings. Again, our starting point is adding our parent company to our subsidiary company. And so since we added in 100% of the subsidiary, we want to eliminate 100% of the subsidiary. So we have 40,000 for our common stock that needs to be eliminated. We have 24,000 for other contributed capital that needs to be eliminated. And we have 19,000 for retained earnings that needs to be eliminated. Now, you might have noticed that we have some other columns in our computation and allocation of differences schedule that I did not fill out. And that's because we're not always going to need all of those numbers. So I've just kind of skipped them to save time. But this column will always be 100%. And then we will divvy that column up between these other two. So if you wanted to fill out the rest of the schedule, you would just need to take this total column and multiply it times the parent percentage, put that number here, the non-controlling percentage, and put those numbers here. Okay, so we have our subsidiary equity that we're getting rid of. We have our parent investment that we're getting rid of, but our journal entry doesn't balance. And the reason it doesn't balance is because we have this difference between implied and book still. So I'm going to do an extra step that your book doesn't do, but this will come in handy later. So what we're going to do is if our difference between implied and book is positive, we know that's going to end up being a debit in this first entry. If it's negative, it's going to end up being a credit. Either way, it's basically a plug to make this journal entry balance. So we're just going to record difference between implied and book. Okay. Now, difference between implied and book isn't an account that can show up on our balance sheet. That's not a real thing. So we need to get rid of that. So in this very next entry, we are going to undo what we just did. So we debited difference between implied and book. So now we're going to credit it. And we need to find a new place to put it. So we'll talk about this a little bit later, but our difference between implied and book can be used to make fair value adjustments or to record goodwill. And as they told us here, that any difference between book value of equity and the value implied by purchase price relates to goodwill, that means we know in this case, this whole $7,000 is goodwill. So right here, we're debiting goodwill, which creates that asset on our balance sheet, on the consolidated balance sheet. Okay, so remember, these are eliminating entries. They're in orange, which means they are only on our worksheet. And so the next thing we have to do is just reformat them to adjust our balance sheet to get us to a consolidated balance sheet. So again, we're starting with the parent's general ledger, adding to it the subsidiary's general ledger. We're going to make some adjustments here, and then our consolidated balance sheet is going to be in this column. So first thing we need to do is debit common stock. So we're just taking these entries up here and reformatting them. So we are going to debit common stock, and remember, this is the common stock of the subsidiary, so we're going to make sure it's on the right line because we have them on two different lines. So we're going to debit for $40,000. We're also going to debit the subsidiary's other contributed capital for $24,000, and subsidiary's retained earnings for $19,000. Going to go check our entry up here. We also need to debit difference between implied and book for $7,000. Then our credit is going to be to investment in S for $90,000. I'm going to go down to the bottom and I'm going to sum up our debits, and our credits columns. And so I can see that both of those are 90, so I know my journal entry I just entered balances. And then we have one more entry we need to put in here. That one is going to create goodwill. So I'm actually going to start with the credit on this one. So we are undoing our difference between implied and book, and we are instead putting it in goodwill. Again, just reformatting this entry into our worksheet format, and again, checking our debits and credits balance. So to get to our consolidated column, what we're going to do is we're going to add our parent to our subsidiary. And then on the asset side, we know anything in the debit column is going to increase assets. So we're going to add anything in the debit column, and we're going to subtract anything in the credit column. We're going to do that for all of our assets and then sum them up. On the other side of the balance sheet, we're again going to add the parent and the subsidiary. But now, when we have a liability, anything in the debit column is going to decrease that balance. So we're going to subtract anything from the debit column and add anything in the credit column. Again, we're going to drag that down and sum this up. So our balance sheet balances, so that's good. And now we can take a look at this and see that we've done a few things that we thought we needed to do. Our investment in S is now 0, so we've gotten rid of that, so we're not double counting that anymore. We've also gotten rid of all of our subsidiary equity, so all of those accounts are 0 as well. So we know that we've gotten rid of all of that double counting that we were worried about. So this is a better representation of the true consolidated entity than when we just added things together and were double counting. If we were going to put together our financial statements, these are the numbers that we would take and type into our Form 10-K and issue to the SEC. Okay, so now that we've seen how the CAD works in a simple scenario, let's add a new complication. In the last example, the parent company owned 100% of the subsidiary. In that case, the resulting financial statements should be identical to what they would look like had the transaction been an asset acquisition. However, one of the advantages of a stock acquisition is that the parent does not have to own 100% of the subsidiary. Anytime the parent company owns less than 100% of the subsidiary, we must record a new equity account called non-controlling interest, which represents the portion of the entity owned by someone other than the parent. Let's look at the example. In this example, we need to prepare the CAD for Prancer Company's investment in Saltez Company that would be used in the preparation of a consolidated balance sheet at the date of acquisition for each of the following independent cases. Assume fair values of identifiable net assets equal book values. So we're actually going to skip case A and go straight to case B. So we're just going to jump right into our computation and allocation of differences schedule. First thing we need to know is our ownership percentage. So again, we are looking at case B here, and under case B, we own 90%. So if we own 90%, that leaves 10% for our non-controlling interest. Those have to add up to 100. Then we're going to put in our purchase price. So in this case, they told us our investment cost was $232,000. So that must be what we paid for our 90% interest. Now we're going to try to estimate what the value is of the entity as a whole by assuming we could have bought the additional 10% of shares outstanding for the same price as we paid for the 90% we bought. So we're going to take our $232,000, divide by our 90%, and that's going to extrapolate that cost across 100% of the shares. We're then going to estimate the value of the non-controlling shares by taking their percentage, or that 10%, and multiplying that by our total implied value. So we get a value of the non-controlling shares of $25,778. Then we're going to compare our implied value to the value, the book value of the entity as determined by adding up all of their equity accounts. Because remember, sum of equity is equal to net assets. So in this case, our company has, again, three equity accounts: common stock, other contributed capital, and retained earnings. So we have three equity accounts in our computation and allocation of differences schedule. Common stock was $190,000 on the date of acquisition. Other contributed capital was $75,000 on the date of acquisition. And we actually had a retained deficit of negative $29,000 in our equity account there. So if we add these guys up together, we get a total book value of $236,000 for Celtez. So we're going to compare our implied value, or our fair value of the entity, minus our book value of the entity, and we get a difference between implied and book of $21,778. So essentially, we were willing to pay more than the book value by $21,778. Now that could be because the entity's net identifiable assets have fair values higher than their book values, or it could be because of goodwill, or both. In this case, they told us that the fair values are equal to their book values. So that takes away the fair value option. So this is going to end up being goodwill. So again, let's practice using our computation and allocation of differences schedule to make our eliminating entries. We're going to start again with our own investment. So we need to eliminate our own investment, which was an asset account. So in order to get rid of that, we are going to credit investment in S. And we recorded it at $232,000. So that's the amount we need to get rid of. We're then going to get rid of our subsidiary equity accounts. So our subsidiary had common stock and other contributed capital. Those have normal equity balances that are a credit, so to get rid of them, we are going to debit them. However, retained earnings has a contrabalance. So in order to get rid of that one, we're actually going to have to credit retained earnings. So common stock will be a debit of $190,000. Other contributed capital will be a debit of $75,000. And retained earnings will be a credit of $29,000. Remember, our starting point is taking our parent balance sheet, adding to it our subsidiary balance sheet, and this entry is doing whatever we need to do to get rid of these accounts. So if we have a retained earnings account that has a debit balance, we're going to need to credit it to get rid of it. Okay, so we again got rid of investment in S, got rid of our subsidiary's equity using these lines, and now we have the new part. So the new part is we need to actually create a new equity account called non-controlling interest. So a new equity account would be a credit. And the amount of that account can be found in our computation and allocation of differences schedule. We just calculated it. So the value of the non-controlling shares is $25,778. So now that we've done all that, we are left with our plug. So our last item left is our difference between implied and book. We can do that by plugging this entry, or we know that because this item is positive, then we need a debit in this account. So that'll be a debit of $21,778. Now remember, we're not done because difference between implied and book can't stay on our balance sheet. So we're going to turn around and undo it. I know this seems a little silly at the moment, but I swear I have a reason, and we will get to it eventually. And we're going to allocate it someplace more permanent. In this case, they told us that that entire difference is due to goodwill. So we're going to create a asset account called goodwill for $21,778. For our next complication, we are going to consider the bargain purchase. Recall that in a bargain purchase, the parent company pays less than the fair value of the net assets acquired and recognizes a gain on business combination. However, FASB rules says that the gain can only be recognized on the shares that actually changed hands. So if a parent owns 80% of the subsidiary, then 80% of the bargain will be recognized as a gain on the income statement, and the remainder will be allocated to the non-controlling interest. This essentially increases the value of the non-controlling shares by their portion of the bargain. In this example, we are again looking at Prancer and Saltez, but we've moved down to scenario C. Last one we did was scenario B. So again, we're just going to start with our computation and allocation of differences schedule. We're going to start with our ownership percentage, which this time we own 80% as the parent. That leaves 20% left over for our non-controlling interest. To get our 80% share, we spent $159,000. And we're going to extrapolate that to estimate the value of the entire entity by taking that amount and dividing by our ownership percentage. So that gives us an implied value of the entity as a whole of $198,750. Our non-controlling interest, their shares are going to be worth 20% of that total, or $39,750. So that's the part that was new in the last example. Now we're going to compare that implied value to the entity's book value. So we've been doing this from the beginning. Again, we have 3 equity accounts. So we're going to put them all in here. This time, common stock is $180,000. Other contributed capital is $40,000. And retained earnings is still at a deficit of $4,000. We're going to sum these guys up, and we get a book value in this scenario of $216,000. So right away we can see something is different because this is going to be the first time that our book value is higher than our implied value. So when we calculate our difference between implied and book, we're going to get a negative number. And so that's new. We didn't have that happen before. So let's go right to our eliminating entries. We're going to follow the same kind of steps we did before. We know we want to get rid of our investment in S, and that's going to be a credit. So to get rid of an asset account, we're going to credit. Our original investment in S was $159,000, so we have to eliminate $159,000. We then need to get rid of our subsidiaries' equity accounts. So common stock and other contributed capital both have credit balances. So to get rid of them, we're going to debit them. Common stock had a balance of $180,000 on the date of acquisition. Other contributed capital had a balance of $40,000 as of the date of acquisition. And then retained earnings had a debit balance. So to get rid of that one, we are going to credit. And that one on the date of acquisition was $4,000. So we're going to credit $4,000. So now we got rid of our investment in S, we got rid of our subsidiary equity. Next step is to deal with our non-controlling interest. So because we don't own 100%, we do have a non-controlling interest, which means we need to create a new equity account. Equity accounts normally have a credit balance. So we're going to create non-controlling interest for $39,750. And now this time, you'll see that in order to make our journal entry balance, for the first time, we need a credit instead of a debit. And we could have known that already because we have a negative number in our computation and allocation of differences schedule. Again, I'm doing one more step than what your book does. If you want to see what your book does, all you need to do is take entry 1 and entry 2 and collapse them. So any accounts that have the same name, you're just going to collapse them, or you're going to add them together, and then, or net them out, depending, and then you would get the entry that your book would do. So in step 2, we're going to get rid of our difference between implied and book. So we originally credited it, so this time we're going to debit it. And now we need to figure out a place to put these. So again, it might be fair value adjustments, except that they told us to assume the fair values of the identifiable net assets equal their book values. So there are no fair value adjustments. So then we think goodwill. Okay, except we're looking for something with a credit balance, and goodwill by definition is an asset that has a debit balance. So that's not going to be right. So this is our bargain purchase situation where we paid less than the value of what we got. So we know from our asset acquisitions that this results in a gain on purchase of purchase of our subsidiary. But the thing that's new is that under this situation, we are only allowed to take the portion of the gain for the shares that actually changed hands. So we're going to go back up to our computation and allocation of differences schedule, and we're going to take 80% of our difference and 20% of our difference. And this part, that 80% of the difference, is the only part we're going to be allowed to record as a gain, because that's the part that relates to shares that we actually bought. The rest of it, we're going to give to the non-controlling interest. And so as you can see, we are going to increase the value of the non-controlling shares because we originally recorded them at $39,750. We're adding to that an additional $3,450 because we're saying, well, if we get to record a gain, essentially they do too. Their shares are worth more because of their portion of this gain that they could do this to. And so that's the tricky thing about the gain on bargain purchase, is that we need to split our difference between implied and book and treat the parent share differently than we're going to treat the non-controlling interest share. This concludes our lecture on the computation and allocation of differences schedule. Don't forget to email your questions for our discussion.